Okay, good afternoon, everybody, and welcome to today's Friday live webinar. My name is Emmanuel Olalekan Akinola, Market Analyst at HFM Nigeria. I hope everybody's doing all right. I hope we're doing well. I hope to a certain extent you're enjoying your weekend. Thank you for joining us in the session today. Today, we want to discuss a very interesting topic: position size scaling. I mean, it's a topic, not too deep a topic as the case may be, but still a topic that should get some level of attention from us, and we absolutely need to learn how to do it, the right way, and some other strategies, things that you can do to ensure that to a certain extent you manage your account appropriately and you trade in the right direction. And there's a reason why I started from the company's website. And the reason is because I'm going to show you some things, some really interesting tools that we currently have and what they would do, to help your trading get better, your understanding of your own account, and how you can effectively manage your own experience, manage your own risk, and manage your own exposure to the market. Are we there? Now, you see, before we even get started, talking about what I have for you in the session today, we need to start from, understanding what we even mean by position sizes, right? Now, position sizes, otherwise known as volume, otherwise known as quantity, otherwise known as lot sizes, is the quantity or the volume or the amount of that particular instrument or asset that you're looking to buy or to sell in the market. Every single time you want to open a trade, and every open trade that you're going to have in the market, as the case may be, you would be required to, tell the broker, at least specify to the broker what lot size you're interested in trading. Is it the micro lots? Is it the mini lots, or is it the standard lots, as the case may be? And in this particular business, one thing you would note is that in the grand scheme of things, the lot size you're trading or the instrument you're trading, the volume of that particular instrument determines the in and out in your account or for that particular trade. It determines how much you're going to be making. It determines how much you're going to be losing on the board. It determines your exposure in the place of what you can even set as a stop loss, what you can even set as, a take profit in the market. It is one of the most crucial things that you need to understand, about this particular business, because if you mistakenly use, a lot size that you don't, understand, or you're not prepared for, or you don't even have the right account to take, but you were able to take it because of the presence of leverage in your account, and you don't understand the implication of what you have just done, it is quite possible that you might eventually, you know, have some difficulties, managing that particular account. And that's why today, this very particular topic is so important. And like I said, we have three major umbrellas in terms of lot sizes in this particular market. We have the micro lot, we have the mini lot, and we have the standard lots. We have the micro lot, we have the mini lot, and we have the standard lots. Are we together? Now, you see, the word micro, as the case may be, means small. You know, tiny, something not too big. The word mini, could mean medium. Mini, medium, they look like, synonyms as the case may be. And the word standard means big to a certain extent. Right? So you see, in this market, when we talk about micro lots, we're talking about when you trade instruments from 0.01 down to 0.09, where 0.01 equals to you buying or selling 1,000 units, of the asset in question. Don't worry, I know you're bigger than this and you're beyond this, but there's a reason why we are starting from here, right? Where 0.01 is equal to 1,000 units of the asset in question. It then means that if you're trading 0.02, it means you're trading 2,000 units of the asset in question. If you're trading 0.03, it means you're trading 3,000 units of the asset in question. If you're trading 0.04, you're trading 4,000 units, 0.05, about 5,000 units. If you're trading up to 0.09, it just works with a number about 9,000 units of the asset in question. Now, if you leave that particular environment and you go into the mini lot continues from where the micro lot stopped. So if the micro lot is going from 0.01 to 0.09, and that's its own threshold, the threshold of the mini lot resumes from 0.10. Because if you stop at 0.09, the next thing after that is 0.10, right? So mini lot picks itself up from 0.10 and it stretches it out to 0.90, where 0.10 equals to you buying or selling 10,000 units of the asset in question. Now, what this means is if you're trading 0.10 in this particular market, it is 10,000 units of the asset in question, 10,000 units of the asset in question. If you're trading 0.20, it is 20,000 units of the asset in question. If you're trading 0.30, it is 30,000 units of the asset in question. If you're trading 0.40, it is 40,000 units. If you're trading 0.60, it is 60,000 units. So if you look at that and you begin to, talk about what we have, currently on the board, you understand where I'm coming from, saying that, from moving from the micro lots, we move to the mini lot, and then eventually we get down to the standard lot that continues from where mini lot stops from 1.0, and we say that one goes and above. So we're going from the micro, which is small, down to the mini, down to the standard, right? Now, in this particular regard, what is well, this one also says where 1.0 equals buying or selling 100,000 units of the asset in question. Now, what we also need you to understand here is every of these lot sizes are available for you to trade in the market, no doubt. You can trade 0.01 or 0.02 or 0.03 or 0.04, 0.05 to 0.09. You could trade 0.1, 0.2, 0.3, 0.4 to 0.9. You could trade 1.0 and above, but you need to understand that every single lot sizes that we have in the market, there is only one reason why the broker requires you to set up a lot size or a position size in the market. It is to define what level of exposure you want to have on that particular trade. What level of exposure do you want in the sense of how much do you want to be losing per movement and how much do you want to be making per movement? And if you look at, this particular calculator that we have on the company's website right here, the p-value calculator here, it helps you to calculate how much you would be winning or losing on every instrument that you're trading on in the market. For example, if I put in 0.01 here and I calculate this, 0.01 is offering me 10 cents for every movement in the market. It is offering me 10 cents for every movement in the market. What I say is when I'm making profit, it is offering me 10 cents per movement. And when I'm also making losses, it is also offering me 10 cents for every movement also against me in the market. What this means per se is this. It means the implication on 0.01, for example, is you stand to win or lose 10 cents per movement, right? And that's for 0.01, right? On 0.01, you stand to win or to lose 10 cents per movement in the market. Now, also, remember that 0.01 is not the only, micro lot size that we have. We have 0.02, which means you could also account, for what 0.02 implication is on the board. This is about 20 cents. If you also put 0.03, it offers you about 30 cents. If you put about 0.05, it also offers you about 50 cents for every movement, plus and minus. If you go as much as 0.09, which concludes the micro lot, it offers you as much as 90 cents per movement. Now, the moment you cross into the mini lot territory 0.10, and this takes you to a full dollar per movement, one full dollar for every movement that we have on the board if you're trading the mini lot. Now, on the mini lot now, the implication on the mini lot is simply implication. You stand to win or lose one full dollar per movement. You start to win or lose one full dollar per movement. Now, you can see the change between what you're being offered you can see the change between what you're being offered in the market right now, for example, and the micro lot 0.01 is offering you 10 cents. The mini lot 0.10 is offering you at least about $1. Okay? It is offering you about $1 each. Okay? $1 each. So now the difference between what the micro lots are offering you and what the mini lots are offering you is the micro lots are simply offering simple 10 cents every movement on 0.01. The mini lot 0.10 is offering you as much as $1 for every price movement. And the standard lot, we'll check the standard lot now. But while I want to do that, just give me a second. I think we have people who are finding it difficult to join the session. Let me see. Let me see. Yes, we can continue. We can continue. Apologies with that. So yes, so now we understand that the micro lot offers, about 10 cents per movement. The mini lot offers about, $1 per movement on 0.10. And that means if you're doing that means if you're doing mini lot 0.10, you're getting about $1 for every movement. Now, if you decide to go as high as 1.0, right? 1.0, calculate, offers $10 for every movement. $10 for every movement. Implication, you stand to win or lose $10 per movement. Now, this is actually common knowledge. For most people, this is common knowledge. And there's a reason why I did this, right? And please note that this is on 0.01, not all of the micro lot. This is on 0.10, not all of the mini lot. And this is on 1.0, not all of the standard lots. Now, like I said, this is common knowledge. And there's a reason why I am doing this. There's a reason why I decided to send this to you, as the case may be, or why I decided to run us through this particular aspect of, um, lot sizes on the board. It is because every other thing falls under this particular umbrella. So I hope to a certain extent we now understand the different lot sizes we have in the market and why they are so important. They are so important because it determines how much, every movement will be plus or minus. Either the market is going for you or going against you in the market. It's imperative because you definitely need to control what your lot size will be in order for you to be able to control your account effectively. If we're talking about position size scaling, if we don't even have the right lot size on the board to use, how do we effectively scale, our lot sizes in the market? How do we get to talk about the psychological aspect of what this particular thing is all about? So, in conclusion of this particular aspect, in the first place, when it comes to lot sizes in the market, it's the quantity of transaction you're willing to take in the market, distributed into three different umbrellas: the micro lot 0.01 to 0.09, the micro lot 0.01 to 0.9, the mini lot 0.10 to 0.90, and the standard lot 1.0 and above. Altogether, micro lot 0.01 to 0.09, mini lot 0.10 to 0.90, and your standard lots going from 1.0 and above. Remember that the implication of those lot sizes is in the dollar value or the naira value that you will be charged or that you will gain for every price movement for or against you in the market. Now, we want to talk about, the risk management aspect of this particular lot size. Guys, think about it, right? Think about it. You want to trade and you have an account. I'm going to pull up just an MT4, for example. You have an account, and having talked about this, I'm going to remove this. I'll bring it back later when I need to bring it back. I'm going to remove some of this as well, so that we don't get distracted too much. Now, firstly, I'm going to talk about picking the right lot size that, helps your account, for example, and puts it in the right direction. So this is my own account. It's my live account. And I currently have about 10K. It was down before, but back up now. And let's say you want to trade, and this is where you're required to put up volume, right? Volume also relates to what's it called? Your position sizes or your lot sizes in the market. Now, when you're thinking about what to use as volume, do not connect it only to the opportunity that you're looking to make in the market. You know, a lot of people only connect it to the opportunity in terms of what they are willing to make right now. People don't even connect it back to their account and how this particular lot size sustains, the accounts that they have on the board. Take, for example, someone is seeing an opportunity where he or she wants to buy or he or she wants to sell this particular assets in the market. And this particular person is feeling like, what lot size can I use? I like this opportunity. Maybe to a certain extent, maybe it is even an opportunity that maybe you got from a signal or something, or maybe your own analysis, as the case may be, and you found a key level of support on the board, and you feel like, okay, I can take a buy on this particular opportunity. I think that there's nothing else the market can do. I can buy. Now, but instead of you to first think about, all other things before even thinking about how the confidence or the level of confidence you have on that particular trade is before you determine what your lot size is going to be, you need to start from somewhere. And this is how I like to think about it. Start from sustainability, because I remember that one of the major things that I said is you have to balance out, profitability and risk, for example. So let's take it a little bit further. So we're going to draw another arrow somewhere. And in this case, we're going to start a different metric of measurement. Now we're going to say, for example, I want to, effectively pick the right lot size that, manages my account. I first think, what is my account balance? What is my account balance, right? That's going to be the first question I'm going to ask myself. How much do I have in my account? In this particular case, I'm going to use an hypothetical example. I'll start with $100. $100. Then I'm going to ask myself, how much no, I don't want to get to how much yet. I want to start from what lot size can sustain my account. Now, in order for us to answer, the lot size that can sustain our account, we need to do some calculations, some permutations and whatnot. And I want to do a very simple one. I want to do a very, very simple one. For example, listen to me. We've just checked together that on an average major pair, even on the gold market, on 0.01, right? One price movement, which is 1 pip, is simply 10 cents. It's 10 cents. On 0.02, for example, one price movement on a major pair on the average gold market is 20 cents. On a random 0.03, 1 pip movement also is about 30 cents. And I want to go to on 0.10, which is a mini lot, 1 pip movement is $1 on the average major pair and even the gold market. On 0.20, as the case may be, one price movement equals to $2. And on the average 0.30, there's a reason why I'm doing this. I need you to see something. One single pip movement is equal to 3.00. And I'm going to go to the standard lot on 1.0. 1 pip, one single price movement is about $10. So what I'm going to do is, since I don't want to go beyond 1.0, I'm going to increase that of the micros to 0.05. So I'm going to go back up here and try to increase this one on 0.05, sorry, 0.04 now. 1 pip is about, 40 cents on a major pair on an average gold market as well. And on 0.05 as well, 1 pip equals to about 50 cents. So we're starting from a simple question. What is my account balance? It can be hypothetical, right? In this case, we're just assuming $100, which is the common balance. You can always do for whatever account balance you have. And I want to find out what lot size can sustain my account in a certain extent. Let me show you what my intention is. I'm going to pull up a calculator, and I'm going to begin to show you some things. I can get rid of my lines so that I can focus on less information on the screen. Now, if you take your $100 and you divide it by 10 cents, which is on 0.01, it would take the market 1,000 pips for you to lose that particular account. 1,000 pips. If you're going to lose this account, the market needs 1,000 pips to lose your 0.0, to lose your $100 account if you're trading 0.01. I'll do the next one. Your $100 account divided by 0.20 reduces the amount of pips that the market needs to go against you to lose that particular account to 500 pips. Stay with me, oh. Just stay with me. I go back. If I'm on 0.03, my same $100 account divided by 30 cents reduces the number of pips that the market needs to 333 pips and 33 pipette, as the case may be. I will do the one for 0.04 so that I can just write the two together, which is 40 cents. And this is about 250. So let's write them. Now this one is 333 pips. And this one is about 250 pips. Now this definitely is your 100 divided by 50 cents, which should give you about 200. Now, this is about 200 pips. Now let's even start from the micro environment. So I put about $100 in my account. I want to start trading. Now I want to first find out what lot size can, actually first sustain this account. And the reason why I'm first talking about sustenance and not yet about making money is because to a certain extent, in this business, your first initial objective is capital preservation. Your initial objective in this business is not flipping. Your initial objective is not turning water to wine. Your initial objective is not to make times 10 or times 50 of the amount of money that you have. So the reason why I'm saying capital preservation is because as first, when I open my account, the first thing at the back of my mind is capital preservation. How do I ensure that I don't lose this account anyhow due to novice mistakes or rookie mistakes, or even mistakes that are not even novice, but the market just doing whatever the market wants to do, at a particular point in time? You need to understand this concept of choosing the right lot size, because we're talking about position size scaling for your account. You have to scale your lot sizes appropriately for your account. Now, if I'm trading 0.01 on a $100 account on a major pair or a normal, what's it called, market, it would take the market 1,000 pips for me to lose $100. 1,000 pips. If I increase that particular lot size to 0.02, it completely halves the amount of movements that the market needs to take against me for me to lose that account. It takes it to 500. Another slight increase to 0.03 takes it to 333. Another slight increase to 0.04 takes it to 250. Another slight increase to 0.05 takes it to 200 pips against you. Now, you must understand that one of our major goals in this business, like I said, is capital preservation, but at the same time, it is to create a balance in the place of, risk exposure and also making money. In the sense where you cannot also be too concerned about managing risk and also completely forget that whatever lot size you're using determines what goes in and what comes out. In the sense where you cannot say, since 1,000 pips, make sure that my $100 account sustains me for long, I will stay there. You should also be ready to take whatever aspect of profit that comes in, which means emotionally, psychologically, you should also be prepared that it would also be offering, the same 10 cents, and it will also take the same 1,000 pips for you to win $100. That's the way you must think about it. That if it is going to take the market 1,000 pips for you to lose your $100 account, it is also going to take you the same 1,000 pips to make the same $100 back. If you're okay with it, you stick to it. If to a certain extent you like the fact that it sustains the account, but you're not comfortable with the fact about how much you'll be willing to make or what it will bring to you and the pace to which you're going to be able to make it, you must find a common ground. And the reason why you must find a common ground is because the psychological impact of using a lot size that help you manage risk, but you're not okay in the place of making profit, is that eventually you would be looking for opportunities to increase your lot size, by looking at opportunities in the market just because you want to make more. And the idea is we don't want you to get to that point where you begin to, adjust lot sizes anyhow, increase it today, downgrade it tomorrow. Tomorrow you are here, the next day you're there. Is because you still don't understand how to properly scale what particular lot size fits the account that you are trading. It is firstly preservation, but also you must strike a balance in, okay, it is about preservation, but also at the same time, if I'm making money, would I be okay with the pace? If it is going to take the market 1,000 pips for you to lose your $100 account on 0.01, it will also take you 1,000 pips accumulation for you to also win the same $100. It is faster on 0.05. 200 pips, you already made $100 on 0.05, but you must also understand that the 200 pips as well, your account is done. So what we must do is we must find a common spot. That common spot that you can stick to. That common spot that to a certain extent you can stay with it up until your account grows. And when your account grows again, you can do another, calculation to see where you expect it to be. Now, imagine someone who has $100 account and is trading trading 1.0. In this case, $10, you only need 10 pips before that account is wiped off. It does not make too much sense. Even though leverage will make it possible for you to be able to open that trade, but your account cannot carry that trade. Your account cannot sustain that trade. Because this one reduces it to 100 pips. Yeah. This one takes it to 50 pips. This one less than, let's say, the same 33 or something or thereabout. You need to understand that your first goal at first is, okay, what preserves this account? Check the pip values of the lot sizes available that you have at the back of your mind. Use them to divide your account balance. If you're trading 0.01, use your account balance, use that 10 cents to divide that account balance. You're dividing your account balance by the pip value of the lot size. This calculation was done by dividing divide your account balance by the p-value of proposed lot size. And you would be able to find, multiple options. Then you then carefully considering which one sustains your account, but not only sustainability, but also which one takes you to the point where you're also comfortable with the aspect of making profit. But like I said, guys, on your account, the first thing is capital preservation. That's the first thing. Capital preservation. Are we together? Even if your account is not $100, even if your account is $500, you can still divide it by the lot sizes available, their p values, and see which one sustains that particular account, and also ensure that you are still also comfortable in the place of making profit. Now, you must also note that also when we talk about position scaling or position size scaling based on account types, it is also okay to a certain extent. For me, I do something like this. I do something like this, and I probably think I can teach you also something like this today. For example, it's also possible that you are the type who likes to, how do I put it? You're the type who likes to enter a big lot size, when you see a better opportunity, as the case may be. You might be the type. But there are also other ways to which you manage exposure, especially with trades. Maybe even you're going in with big lot sizes or small lot sizes. We have what we call partial closures, for trades in the market. Let me see if I can find any trade, remotely worth taking, because this is a live account, so I cannot just open anything in there. Let me see markets with good fundamentals right now, like USD JPY has a solid bullish fundamentals right now, but also ranging right now. We've had some key support levels help prices go up. What about ADJPY? Let me see. Also just ranging today, not stepping back lower. I don't know. Okay, say for example, just as an example, I have something like this, right? I have, a bearish price movement, in here, right? And I feel like over time, the market steps down from anywhere within this particular territory, right about here. And that the market has now struggled, pulling up a little bit. And maybe to a certain extent, you do believe that this market is going to fall. And I'm talking about this on another pedestal. The first pedestal is one I've explained that you should choose your lot sizes based on the one that ensures sustainability in terms of how many pips it will take the market to lose that particular account, that lot size that sustains that account the most, but also that you're also comfortable in the place of what you're going to risk should be the major thing. Let us assume now, this is second pedestrian now. Let us assume that to a certain extent, this market actually is a seller's market, not away from even just the technical basis. Let us say that to a certain extent, it's a seller's market. Now, under normal circumstances, the market sells this particular asset, majorly from somewhere around here, here, and then you're also thinking if you can get a sell in from somewhere around this point, you could also think about potential downside on the market. Now, one way to go about this is I could think, okay, let me put up a pending order, right? I set up a pending order, and I look at the price somewhere around here, and maybe I have something around 1.78917. I pick the appropriate pending order that I need to use here. Sell limit at the price 1.79817, right? And then I put this in. But now I also need to set up my lot size for this particular trade, for example. Now, if you're a 0.01 trader already, you don't have anything to do here. You set 0.01. If you're a 0.02 trader, it's fine. You can set 0.02. If you're 0.03, but irrespective of what you do, for example, you can set in the lot size. In this particular case, if I was not a 0.01 trader, say I was a 0.05 trader, for example, or maybe a 0.02, 0.03 trader, as the case may be, I could easily put in the full lots that I used to trade and put in something like this. You know, I can put in 0.02. Let's say I'm a 0.03 trader, true trader, for example. I put a place. It's not taking it. Why? Oh, it has reset this to 1.782917. Boom. So now I have like, a lot size somewhere around here, a pending order, for the market to take me in for a sale around this particular point. My full lot size, based on what I'm interested, in losing on this particular account. And then I can put up a stop loss if I want, say somewhere around, just above this particular level here. Maybe like 1.79200, which is how many dollars away. You can measure that if you put a crosshair here, it's about maybe 25 pips away or thereabout. I can say about maybe about 30 pips away though, and that's about 1.79226. So I can just put up a stop loss, say 1.79226, for example, and I press modify. This here is a normal trade preparation. Normal. You see a downside market off a trend line, you want to sell, and you understand that the market has not appropriately tested that particular region. So you think, okay, let me put up a pending order, and then after the pending order, let me put up, a stop loss and see how it goes. Now, this is proper setup, for someone who is willing to wait. But let's say it is a market where you feel like, what if the market does not go back up in here into this particular region? What if it just breaks below this particular neckline here and just continues to go down? And you don't want to miss out on that opportunity. This is how to go about it. Well, in my own opinion, this is how we go about it. And the truth is, you can never be sure about anything on the market or anything in the market space. You can never be too sure. But for me, I feel like if for some reasons I don't want to miss out on a move because I feel like this market could just break below this particular move here, this particular neckline, and just continue to go, two ways I can go about it. I can absolutely wait for the market to breach this. I wait for a retest and I sell. Or I could easily just go into the market. Let me first delete my pending orders because that's the proper one. Delete this. And I just exactly, instead of taking the normal 0.02, I will take a 0.01. Listen, see what I've just done. I am a normal 0.02 trader. I even use 0.02 to set up my pending order, which is the appropriate level to enter from. Waiting for a move back to the trend line before I enter, I set up my appropriate 0.02 trader. Now, but on this particular case, because I don't want to miss out on a move and I don't want to assume it's just going to go back or it's not going to go back, I just want to take a sell. I have purposely downgraded it to 0.01 and I have taken a live trade sell 0.01. Now, why do you think I did that? I did that because to a certain extent, I've been able to establish the likelihood that it's not like the best option right now to take a sell. The best option naturally will be to wait for a return back to the trend line and take an appropriate trade, allowing market go down. But in this case, I feel like the market could just go below this particular neckline and just continue to end lower. Maybe you have a factor, maybe you have a high impact event somewhere, or you have a reason why you just feel like the market is not going to head back to this particular point, or maybe you're even about to get busy at work and you just don't want to miss out on something. It wouldn't really make too much sense to enter all your lot size at that particular point in time, knowing fully well it has not, checked all the boxes of where you're supposed to enter from. So rather, you can put in a 0.01. And the reason why you're doing this is you're waiting to see how the market wants to move. Now, even if the market is going to move against this particular 0.01, this is what you're looking forward to do. You're looking forward to waiting for the market, even if they don't go beyond this, to pull back up a little bit. Now, just for example, if market decides to pull up back into this particular region, confirming that you are expected to sell from here, this is what I do personally. I then enter into the right lot size here, 0.02. Now listen to this. Remember that this one is still running, right? Which means you're a normal 0.02 trader, but by the time you enter a appropriate 0.02 here, you now have 0.03. This is how we go about it. This 0.02, we have its own stop loss, appropriate, up here. But then this particular trade that you're looking at that is still running, this one, the moment the market starts going against it initially, all this box here cannot have your stop loss anymore. It means you cannot put a stop loss here again for this particular running trade. Like you cannot afford to have a stop loss in the middle of this pack anymore. Whatever stop loss you're putting for this trade needs to be above this particular level, maybe somewhere around here. Accounting for the fact that the market can still get here and continue its move lower, right? So it wouldn't make any sense that you already entered into a trade because you feel like you don't want to miss out. And eventually you still put a stop loss within the box here. And then the market just does something like this. It has taken out your trade and continues to move lower. And then you've taken a loss, but although you expected to enter a new one, you win that one. It's not eventually a good position killing, as the case may be. Rather, your stop goes above that particular level. And then, listen to this. This is what most of you don't do. You ensure that once the market gets here and you open a new trade at this particular point, the take profit of your running trade must be exactly on it. I don't know if you get that. It means that the moment, I cannot do that now because the market is not yet going against this particular market yet. But the moment this particular market goes back up here for you to enter into a new trade, you must set the take profit of this current trade to its entry point. The market will allow you to do that. So that the moment this market continues to go down, which is 0.02, it triggers off the 0.01 you put in there because you did not want to miss out on a trade, not because you wanted to take it. Because you don't want to overextend the pressure on your account. Remember that you're a 0.02 trader because you have considered what sustains that particular account. And you found out that 0.02 sustains the account. Having 0.03 running because you felt like, let me use it to make more money, is you going beyond the status quo and you exposing that account to more pressure. So the moment you see that, okay, I've confirmed that the market actually wants to take a sell from this particular trend line around here, and I see that all things are equal, I can take a sell. Once you take a sell, you must immediately start adjusting the stop loss and the take profit of the one you took initially, so that the market can immediately close it the moment it gets there. And the reason why you're doing that is because you never can tell what the market intends to do. Because, for example, who told you that when the market gets here and it starts to pull lower, it's going to do this? What if the market intends to do this? Remember that you are already prepared for a loss on 0.02 under normal circumstances because it is what you normally trade and you already have a stop loss for it, so you're prepared. But you are not prepared for a 0.03 stop loss on your account because now you're taking your account away from a comfort zone that you have already, put it on for a while. So you don't leave that one running, saying, I will maximize it. Listen, you can never tell what the market intends to do. So we must already start scaling that one immediately. We enter the right one. You must start scaling that one, move its take profit straight to it, like on the entry point, so that when the market gets there, it takes that one out at zero and you're fine. And you're going to pay attention to the major one, which is the major lot size you intended to trade. And lastly, one of the other things that we must also talk about is that you are also opportuned to do what we call partial closures on your trade. Say, for example, you want to have a a trade. For some reasons, I also do something like this. For example, I do it majorly on the gold market. I'm not encouraging you to do it, but I like to do it majorly on the gold market. Say, for example, I feel like, well, maybe don't let me use gold for you because some of you, I don't know how exposed you are to trade. And let me use a currency market. Take, for example, this same asset, right? I can close this, done with the example. Say, for example, I have like, okay, yes. I have this here, and I have like a level of support. Let's say my own opinion is to buy this off the support now. Let's assume that this trend line is not there anymore. I just see an upside movement, based on, a fresh trend line, as the case may be, that the market is pulling up small, 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 small within this particular region. So my own opinion is I want to buy. Let's just say, for example, my opinion is I want to buy. Now, if for some certain reasons you're feeling like taking a big risk to get the initial jump. This is majorly common to gold anyway, where you just want to get the initial rejection move or the initial jump. So you want to have a big lot size in at the time. You must learn how to immediately downsize it once the market, has pulled, to a certain point. You've made a profit that is beyond what you usually make. You must learn how to do what you call a partial closure to immediately cut it down to your usual lot size. In what sense? It's possible that you have entered a 0.05, even though you're a 0.01 trader. It's possible that you have entered a 0.10, even though you're a 0.03 trader or something. It's even possible you have already entered a 0.02 trade, even though you're a 0.01 trader, just because you wanted to get, an initial jump of a move. It's not your intention to hold on to that particular lot size. You just wanted to get that initial jump and then take the profit and go away. But sometimes that causes you to do multiple entries where you catch an initial jump and you quickly take the money, you close the trade. But then you notice that the trade continues to go. Now you're looking for how to enter it again. Rather than doing that, even if you're looking to catch an initial jump, you can do a partial closure of the trade, close out the profit of a certain portion, and still leave that particular portion of a lot size that you're interested in trading on. For example, let me see if I can use a 0.02 buy for this particular example here. Let's just take a 0.02 buy. This is dangerous game because it's in a live account, but don't worry, it's fine. And I'm just looking for initial jump. And that's why I'm doing it on the currency market. I'm not doing it on the gold market so that the market does not use my account to do, I take a 0.02 buy, hoping that the market can just, jump up a little bit and I can make some, profit for myself, on the board. And when the market does that initial jump, because it's possible that the market could buy from up to this point. And that's about how many pips away? About 50 pips away. But because that lot size is not your actual lot size that you used to use, you're scared. So once it just does the small jump, you quickly close it. But unfortunately, the market continues the move. Now you start feeling like, how can you enter it again? And multiple closure, exposes you to so many risks in the market. You're exposing yourself to so many risks, in the market. What you can do is immediately after the first jump or that jump that you see and you like what you can see on the profit stand, rather than doing a permanent closure of all the things, you can do what we call a partial closure. How do we do a partial closure? You can right click on the trade that you want to close, click on close order, and right here that says lot size or volume, change it to the volume that you want to close out. Right? Like, even if this was 0.05, when you right click and you press close order, when you get here, change it to the lot size you want to close out. Don't close out the entire thing, especially if you believe that it is the right direction you have taken. But you enter the big lot size, which is more than what you used to do. You get? So you can immediately after the first jump, you like what you see, you want to take it, you can go to the trade, right click, press on close. When it brings up the trade pane for you to close, you change the volume to what you want to close out. And in this case, since I have 0.02, if I press close now, it will close the entire thing. But because I still want to have a portion of the trade running, I'm going to tell them to only close out 0.01. And I'm going to press close. And you can see that the broker has closed out a portion of the trade and has left 0.01 there for me. You can also do partial closures on your trades the same way, even if you're on the phone. On the phone, when you hold down a trade and you click on close position or close order, the next window it brings to you is a window where you still see lot size, stop loss, and then a close button below. You see that place of lot size, just change it to the lot size you want to close out. When you press close, it will only close the portion of the trade for you and still leave your trade running. The portion that you want to leave running, it will still leave it running there for you. So you need to think about it. First, pick a lot size that sustains your account. Secondly, we also talked about also ensuring that you should only enter your normal lot sizes from, trades in the levels that you have ascertained to be the best levels to enter. Level trades where you're just entering because you don't want to miss out from, please ensure you scale down the position. You could also use partial closures for trades that you're going or stepping out of your comfort zone, taking a bigger lot size. Please also ensure to use partial closures for them. Once you've gotten what you want, scale it down immediately to what you're looking, to trade in the market. And lastly, before I take your questions, please also remember it is only okay to add to winning positions. It is never okay to add to losing positions. What I'm trying to say is when you're winning trades or you're winning positions in the market, it's okay to add more trades to it. But trades that you're losing, it's not okay to add more trades to it so that you can recover it. So it's naturally not good to add plenty lot sizes to the market when you're losing. It only makes sense to add positions to a trade when you are winning. Ladies and gentlemen, we are now open to take your questions, in the Q&A. If you have any questions relating to the appropriate lot size to use for your account, send your account balance, send the lot size you're interested to use. Let us talk about it. If you have questions with scaling down or any other question you have relating to your position sizes in the market, put it in the Q&A. We're going to take a few and we're going to answer them in this session right now. How does leverage affect your account? It determines the lot sizes you would be able to trade on your account. That's all it does. Without leverage, it's difficult for you to trade because the average 0.01 market or the average 0.01 lot size on the market requires a margin requirement of almost $1,000. Leverage is the reason why you can trade it even though you only have $5 in your account. So that's the only way it affects your trade. Um, Can you do more than one take profit on a trade? No, no, guys. No, 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 no. You cannot do more than one take profit on a trade. Only one trade, one take profit. I understand that sometimes you might get, reports from somewhere and they offer you like three different, profit targets, three different, take profit as the case may be. But remember that they are only offering you for you to choose one. If for any reason you're going to use all three of them, please note that you have to enter the trade 3 times. Okay? If for any reason you're going to have to use 3 different trade profits or 2 different take profits, it must be that you are entering the trade 2-3 times. A single trade cannot have more than 1 take profit. 0.1 lot size on a 1K account. Okay, let's talk about it. For example, if you go to the company's website now and you check what the average, 0.1 lot size offers you in the market, right? 0.1 lot on the trading calculator, it's about $1 for every price movement on the board. Now, if you divide your $1,000 by a single dollar, which is the P value, it offers you 1,000 pips for the market to exhaust, your $1,000 account. And the thing to consider here, it will be, if you're okay with it, it makes sense because it is good in terms of losses, also good in terms of profit making, also on the board. But if you're going to be trading the gold market, it might not be sustainable because the gold market, 1,000 pips is 2-3 days. A single account do on the gold market is about 100 pips sometimes. So 1,000 pips sustainability on $1,000 account might not be okay if you intend to trade the gold market. If you're going to be trading the currency market, it is absolutely fine. The currency market will sustain this for you absolutely well, and you would also be able to make money going forward. But if you're going to mix gold with this, you might want to just think about downsizing it, maybe to about 0.05, for example. If you use 0.05, maybe because you're a risky person, that gives you about 50 cents. Dividing your $1,000 by about 50 cents will increase this by another 1,000 pips. So to a certain extent, this by 50 cents, so that, let me see, let me just confirm that, but I'm sure it should give you an extra, yes, an extra 1,000 pips. It takes this to about 2,000 pips. You have just expanded the lifespan of this particular account by doing that. So you might want to consider the risk to reward ratio, and you want to consider, the sustainability and also the asset that you're looking to trade. For example, if you're going to be doing majorly currency market, I don't think 0.10 is bad. A 0.1 lot size is bad. But 0.05 could be better in terms of sustainability. And also, it's also relatively okay in terms of making profit as well on the board, because it will just take you 2 pips to make $1. You get, when 1 pip on 0.1 is $1, 2 pips on 0.05 is $1. So it's almost equal. It's not too bad. And it kind of expands the lifespan of your account. How do you identify a trend line? Well, we're not teaching that today. I'm so sorry. But you can watch videos that we have on YouTube already recorded about identifying trend line. How is it not good for your account when closing trade multiple times? Please reframe that topic, that question. Can you do partial closure on MT4 or MT4? Both of them can do it. Both of them. Like I said, either phone or system. Once you click on the trade you want to close and you click on close position, the next page it brings up is a page that is as if you want to open a new trade, but they now put a close button below, right? Just change the lot size area to what you want to close out, not what you want to leave, or what you want to close out. Once you press close, it will only close that particular lot size and keep your trade running. You can do it on MT4 and on MT5 together. Is it possible to change leverage on your account? Yes, you can even do it yourself. If you log into your HF application, click on menu, go to my wallet. Under my wallet, go to your live account. The live account that you want to change the leverage on, once you click on it, there's a 3 dotted line in form of a straight line like this. If you click on it, it will show you change leverage. You can change it to whatever leverage you want. And if you need someone to guide you to do that as well, you can send a message to your account manager. He or she is going to guide you. 0.2 lot size, okay, on a 1K account. If I'm saying that 0.1 lot size does not sustain it too much, then you absolutely know that 0.2 lot size also does not sustain it too much. It reduces to about 500 pips. It's going to be too much. On a $200 account, what lot size can you use? I cannot pick for you, but I can show you some things. For example, if you have a $200 account, and you use 0.01, 0.01 offers 10 cents for every movement. It will take the market 2,000 pips for them to be able to, for you to lose that account. But you must also understand that it would also take you 2,000 pips for you to make equivalent of the same $200 on this particular bot. If you up it to 0.02 rather. Now 0.02, if you divide it by 20 cents on a normal day, reduces it to about 1,000 pips before you lose your account. But to a certain extent, it balances it out also in the place of making profit as well. So, I mean, you can find a sweet spot between 0.01 and 0.02, or even if you want, you can take it to 0.03. It will reduce it to about maybe about half a gain of this particular figure. But to a certain extent, you might want to consider a sweet spot between 0.01 and 0.02. What's the best lot size for a 2K account? I cannot say that, honestly. Like I said, I cannot choose for you. But I can say, for example, if you have a 2K account and you're trading, let's say 0.05, 0.05, by all standard is 50 cents. You need about 4,000 pips for you to lose that account. If you're trading your 2K account and you're trading a mini lot of 0.10, sorry, 2K divided by $1, because 0.10 is about 2,000 pips. I mean, to a certain extent, you can actually maintain a 0.1 lot size, which is a mini lot on what's it called, on a 2K account. To a certain extent, it is okay in terms of profit making and also in terms of managing losses on the board. But this is not an investment advice, because I don't even know what level of training you have. If you're a beginner or you are an intermediate or an advanced trader, if you're a beginner, you might want to start lower than that, all right? You might want to go as low as 0.05, 0.03, to start up. Then later, you can do a proper scaling to account to lot sizes that actually maintains the account and also gives you a good standing in a place of making profit. How does leverage affect an account? I already explained this. For your leverage, as the case may be, it's what allows you to open position. Without leverages, you can't open positions except you have big money in your account. That's the only thing it affects. Normal leverages is just to help you, open trades without having to commit too much in terms of, how much you need to fund into your account. Like I said to the person who asked, you need $1,000 in your account to open 0.01, which is the lowest transaction in the market on a normal day without leverage. Without leverage. Without leverage. If you don't have leverage on your account, on the average Euro USD market, if you're trading 0.01, the broker requires you to have $1,161 in your account before they open the trade. When you had leverage, it now reduces what you need to $1. This is the only function of leverage on the board. There's no other reason, there's no other explanation, there's no other usefulness of leverage than the fact that it reduces what your margin will be to allow you open trades on whatever account balance that you have. How do you confirm the end of a retracement? Well, only when the market closes the candle testing the level that you're looking for on the board. Thank you, Daniel. See, the problem that I have with trailing profit with this question is most times the trail stop, as the case may be, functions in such a way that once the market takes the initial setup that you take against you, it just immediately closes your trade. Rather, you might want to do a manual trail by yourself. So you have an open trade on pounds USD on, let me see, I need to know if you're buying or selling, Seth. You didn't put that there. And you have an entry point somewhere around 1.33700. Okay, 1.33700. You have a stop loss at 1.34700. Okay, that's a very big stop loss. And take profit is okay, you are selling. Don't worry, you're selling. From the price structure, you're selling. 1.3290. $1.3290. Okay, it's almost there. It's almost there. What are you still looking for? And it's already struggling. There's nothing else to position scale here again now. Don't trail anything again. You're almost at finish line. The distance between you and your finish line now is about maybe 17 pips, maybe 18 pips or thereabout. There's no need. Why risk all the profit you've made? You've made about 60 something pips already. Why risk 60 something pips just because you needed to touch here? I mean, by now you should be out of this particular trade for any reason, because already you can see the market already struggling. It's the end of the weekend, which means there's likely that they close here. By the time they open on Monday, they might open and they start going back up. And if you're going to do, maybe if you feel like you don't want to close, if you're going to trail, you need to take your stop loss from where it is, bring it lower. I mean, you have to bring it lower. That's the only way to protect the trade. Bring it way lower, maybe somewhere around this particular resistance here, or maybe we can even hide it a little bit above the resistance here. But why would I want the market to, go against me this much and still continue to go lower, right? And I'm still not out of the trade when I'm already just short of. I mean, by now, I think you should be out. There's almost nothing to risk anymore. But if it was that the space was still far, say maybe this particular take profit was somewhere here, for example, I would say now your stop loss needs to start coming down by yourself, like manual movement. Don't use trailing right now. Like manual movement, it should be somewhere around here, now, because there's likely the market does this and it continues, right? So by the time it does this, for example, and it continues its move, you can then also adjust it lower again, looking for the market respecting the next level of resistance, this particular level here. So you're just above it again. When the market goes again, you can now find a way again to bring it closer again. So you move it, but ensuring you're keeping it away from the next level of resistance if you're selling, or you're keeping it away from the next level of support if you're buying. But that's if there's still enough space that you're waiting for the market to go into. This one, you're already close to the finish line. I think you don't need to risk that trade going forward anymore. If you try to change your leverage and it's not giving you the options to choose from, you might want to send a message to tradingdesk@hfm.com that you want your leverage changed on your account to so. So you can do that. In case you're no longer allowed to change it yourself, you can send an email, address it to tradingdesk@hfm.com. You want the leverage on your account. Please put your account number there, the trading account number there. You want your leverage changed from whatever it is at the moment to what you want it to be now on the board. If you have other outstanding trades, do you add all the lot sizes together to arrive at the appropriate lots to trade? I think you should do that, yes. If you have outstanding trades, you must ensure that you put it into consideration when you are looking forward to opening new trades on the board. Yes, you have to. Yes, you have to. You have to. You have to. Yes, you have to. Personally, for me, if I have open trades and I feel like all the lot sizes together on the open trades has gone beyond what I think I should be doing at the time, I most likely will not add another one until I close the previous one. So you have to. Now, to close out the session today, someone is talking about how, he wants to understand the difference between risk management and fear, because to a certain extent, he used to hide under the umbrella of, risk management, which is why he closes his trades majorly prematurely, as the case may be. But you need to understand that fear is part of, us as human beings, to a certain extent, no matter what. We say things, that help us combat fear. For example, we say things like, understand that trading, you can lose. If you have the fear of losing money, always accept the risk that you're going to lose before you open the trade. Put up a stop loss so that you already know that, okay, even if I lose this, I'm going to lose this amount and I won't bother too much. So if it is that you have the fear of losing money, the best way to combat it is to always accept the risk through a stop loss before you enter into a trade. If you have the fear of lost profit, which means you always prematurely close trades, when you see small profit, you quickly close it because you don't want to lose it, as the case may be. One way to also combat that is when you take your trades, don't stay too close to it, in the sense where don't look at your trade, head on every minute, every second. If you're looking at it like that, you'll always close it. I've been on this market, for example, since morning. If I have an open trade, you might not even know, because I will just take it to another chart completely. For example, I open a different chart and I will just remove my terminal. So it is possible that you are even still doing other analysis and you have a running trade. You just remove the terminal away from your screen, remove also the chart away from your screen, go to another chart, so that you're not seeing the activities happening and it doesn't give you that impression that go and close it, go and close it. So if you have the fear of lost profit, one way to deal with it is to not look at your chart every moment, every minute. Don't look at your opportunities every moment, every single time. Try to take spaces away from it, but ensure that you already have risk limit set in form of stop losses and take profit in order for you to do that. But you must also understand it's going to take time. It's absolutely going to take time. All right, guys. Thank you. Thank you so much for coming to the session today. It was a pleasure discussing this particular topic with you guys. We want to say thank you for attending. This particular video will be up on YouTube later today. Please prepare in case you missed out on the earliest part of the session. You can read, you can walk back, and then watch it one more time. Please enjoy the rest of your day. Good afternoon.